7 Steps to Becoming Financially Independent. Becoming financially independent is a key life goal for many people. It means having the ability to support yourself without having to rely on others. While this may seem like a daunting task, there are actually some simple steps you can take to start moving in the right direction. So, here are the 7 steps to becoming financially independent. However, before we start our countdown, we would appreciate it if you would hit that subscribe button, and subscribe to our YouTube channel Trot Capital if you want to become more financially independent. Let's get started. Number 1. Organize finances. The first step to becoming financially independent is to get your finances in order. Consolidating all your savings, investments, insurance, debt, personal and business, and non-financial assets in one place can be a long-drawn process. This means creating a budget and tracking your spending. You need to know where your money is going and how much you have coming in. This will help you make informed decisions about your finances. Unless you know where you stand currently as far as your finances are concerned, the blueprint of your future financial life will not emerge with clarity. One way to track your finances is by the use of budgeting apps. The 3 budgeting apps we recommend to organize your finances are Mint by Intuit, Personal Capital, and our favorite, the Every Dollar app. Once you have a good understanding of your finances, you can start working on a plan to save money. This may include setting up a budget and putting money into savings account each month. You may also need to make some changes in your spending habits. For example, you may need to cut back on unnecessary expenses. Making a budget and sticking to it is key to becoming financially independent. However, it is also important to be flexible. Things change and you may need to adjust your budget as things come up. The important thing is to stay on top of your finances and keep working towards your goal of financial independence. Number 2. Cash flow and debt management. If you want to become financially independent, it's important to get a handle on your cash flow and debt. You want to plan for the worst times: job loss, medical emergency, economy, and geopolitical uncertainty. You need to know how much money is coming in and going out every month. This will help you make informed decisions about how to best use your money. It's also important to create a budget and stick to it. This will help you track your spending and ensure that you are living within your means. If you have debt, it's important to create a plan to pay it off as quickly as possible. The sooner you can get rid of your debt, the better off you'll be financially. Becoming financially independent takes time and effort, but it is achievable if you are willing to make some changes in your spending habits. It's important to be mindful of your finances and make smart choices with your money. With patience and perseverance, you can reach your financial goals. Also find out how much debt you are carrying. The only constructive debt is a home loan, as the value of a home is expected to go up over time. Make a plan to get rid of all unconstructive debt as early as possible in life. One must target to get positive cash flow year on year. Number 3. Emergency cash and risk management. The third step to becoming financially independent is to have an emergency fund. This fund should be used to cover unexpected expenses, like a job loss or medical bills. It's important to have enough money saved up to cover at least 3 months of living expenses. Risk management is another important step to becoming financially independent. This means being aware of the risks associated with your investments and taking steps to protect yourself from them. For example, you might diversify your investment portfolio to reduce the risk of losing money if one particular investment doesn't perform well. It's also important to have a plan for how you'll achieve financial independence. This plan should include both short-term and long-term goals. Short-term goals might include things like saving up for a down payment on a house or investing in a solid retirement plan. Therefore, have an emergency fund in place. Buy adequate professional indemnity, property insurance, life insurance, and health insurance for a comprehensive protection. Long-term goals might include things like paying off all your debt or reaching a certain level of net worth. Having a plan will help you stay on track as you work towards financial independence. Number 4. Managing financial goals. The fourth step to becoming financially independent is to develop a plan and set some financial goals. Start with identifying the financial goals and then estimate its cost and the time duration after which you need to achieve it. This will help you determine how much money you need to save and where you want to allocate your resources. Once you have a plan, you can start working on saving money. There are a few different ways to save money. One way is to create a budget and stick to it. This will help you track your spending and make sure that you are not spending more than you can afford. Another way to save money is to invest in yourself by taking courses or learning about financial planning. This will help you make better decisions with your money in the future. Once you have saved up enough money, you can start working on investing it. This will help you grow your wealth over time and eventually become financially independent. There are many different ways to invest, so be sure to do some research and find an investment strategy that fits your goals. The goal at current cost needs to be inflated to arrive at the actual cost for which you will have to save on a regular basis. This is the basic and first exercise for each financial goal. Number 5, wealth creation and second income. The fifth step is to create wealth. This can be done through investment, entrepreneurship, or a variety of other methods. Once you have created wealth, it is important to have a second source of income. This second income can come from a job, a business, or investments. It is important to live below your means and save as much money as possible. The more you can save, the quicker you will become financially independent. It will give you the liberty to work on your own terms, as the income-generating asset will provide you a second income to maintain your lifestyle if required. It is important to invest your money wisely. This means investing in assets that will hold their value over time and generate income. Good examples of these types of investments include real estate, stocks, and bonds. By following these steps, you can become financially independent and achieve financial freedom. Number 6, wealth management. One of the most important next steps is wealth management. Wealth management is the process of growing and preserving your assets. It includes setting goals, investing, and protecting your assets from risks. One of the best ways to grow your wealth is to invest it. Investing allows you to put your money into something that has the potential to grow over time. This can be done through stocks, bonds, and other investment vehicles. Another important aspect of wealth management is protecting your assets from risks. This includes things like insurance, estate planning, and diversification. Diversifying your investments helps to protect you from losses if one particular investment fails. By following these steps, you can help ensure that you become financially independent. Wealth management is an important part of this process. By investing and protecting your assets, you can help secure your financial future. How you manage risks, goals, savings, and investments will determine how well you are able to manage wealth over the long term. Number 7, investing in your future. Investing in your future is one of the most important steps you can take towards becoming financially independent. Investing allows you to grow your money while taking less risk than gambling or stock market speculation. There are many different ways to invest your money. One option is to put your money into a savings account or a certificate of deposit, CD. These options offer relatively low returns, but they are also very safe. Another option is to invest in bonds. Bonds are like IOUs from the government or from a corporation. You lend them money and they agree to pay you back over time with interest. Bonds tend to be much less risky than stocks, but they also tend to have lower returns. The stock market is another option for investing your money. When you buy stocks, you become a partial owner of a company. The value of your stocks goes up and down based on how well the company is doing. This can be a very risky investment, but it can also lead to high returns. Whatever method you choose for investing, remember that it is important to start early. The sooner you start investing, the longer your money has to grow. Investing even a small amount of money each month can add up over time. So that's all for today's video. I hope you all like this video. Please let us know some topics you want to see in this channel in the future. Don't forget to hit the like button and subscribe to Trot Capital. Share this video with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care.